Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with industry veterans Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
All right, I'm Michael Hartzman, and today is Tuesday, July 21st, 2026, and I'm on, as always, with my partner, Dominick Tavella. Welcome to the Lebenthal Report. How are you, Dom?
Doing well, Mike. Back in New York for the time being, and no complaints. How are you?
No, same here. Everything's pretty good. We just had a thunderstorm pass by, but the thunder stopped just in time for us to start our show. So everything is good. And it's a terrible segue, but I'm going to go with it anyway. Speaking of thunder, we had quite the week last week. When the S&P and the tech sector is good, it's great. And when the S&P and the tech sector aren't good, it's really, really bad. So last week, Dom, the S&P was down 1.5%. The Dow was down a little less than 1%. Our favorite, the NASDAQ, was down 2.9%. Year to date, the numbers are still very, very solid. The S&P is up 9.64. Dow is right behind it, 9.43, and the NASDAQ is up 10.15%. But, as I said, the semiconductors really have been driving the market for a good part of this year. And it all, goes back to the massive amount of money being spent on what the market calls the hyperscalers in the race to create AI models that are going to be here to stay. So, semiconductors, chips are everywhere, and it seems like we can't get enough of them these days.
And Mike, I don't know whether it was intentional or unintentional, but that's exactly the problem. We can't get enough of them. So in the context of the major indices, the S&P maybe is 2-ish% off its all-time high. The NASDAQ a little bit more, maybe 5-6% as of Friday off the all-time high. But when you look at these semiconductor chip stocks, this is the most important part of AI technology. You need computer chips to get the stuff to work. There just aren't enough of them. So we get into this constant argument. Do we have enough? Do we need more? Are we ordering too many? Are we ordering too few? And so chip stocks as a whole have had a phenomenal good year, but a really horrific month where they've given back quite a bit of the profit, still up a lot for the year, but down from where they were about a month ago, Mike.
Yeah, and I'm just looking here at what I'm using my JP Morgan cheat sheet like I do every show. And what this basically says is we're having, number one, we're having earnings growth of a little bit more than 23%. But of the earnings, most of that earnings for the year, Dom, is being driven, or for the year and for the quarter, is being driven by semiconductor growth. Let me just make sure I'm reading this correctly. IT is yet again doing most of the heavy lifting. Earnings per share expected to rise 61%, driving 2/3 of the S&P 500 earnings per share growth. So in information technology is accounting for 61% of the earnings in the S&P this quarter. That's phenomenal.
So this is a glass half full. One of the things we talk about all the time is earnings in the S&P 500, and they really, really have surprised on the upside. In fact, earnings in the S&P 500 are up almost 15% for the year. But here's your point, Mike. The concentration of those earnings, a significant portion of it came from just this semiconductor computer space, these large cap growth stocks. So the good news is they earnings have been really good, really spectacular, way above what analysts were expecting. The bad news is a lot of these earnings are concentrated in just a handful of stocks.
I've say it all the time. Wall Street is great at coming up with buzzwords, and once we start using them, it feels like we've been using them forever. And I think the newest buzzword that came along 2, 3 years ago, Dominic, is hyperscalers. The hyperscalers are in a race to build out these AI infrastructure models. What's a hyperscaler?
So in the names that I want to go, everybody knows, whether it's the Microsoft, the Googles, the Metas of the world. These are the very large companies that are using their balance sheets, their earnings, their growth to basically fund AI technology. So again, the glass half full. Last year, these companies committed to spending almost $1 trillion of their own money and borrowed money to build out these data centers, buy the computer chips, and build out the whole AI infrastructure. We were saying it a year ago, Mike. One of these guys is going to finally start making some money. They're spending all these dollars, but are they going to make money this at some point? Well, what we're seeing this year is those guys, the hyperscalers, are now kind of depressed on a year-to-date basis. In fact, the Mag 7 might still actually be negative year-to-date, but the companies that they're spending money on, the computer chips, the data centers, those companies have gone through the roof. So we've seen this kind of migration from old school, what worked last year, to new school, what's working this year.
And I'm glad you said that, because I did get a request for one of our listeners, and I'm glad we have at least one who asked me to have you and I explain the Mag 7. What does that even mean? So I'm not going to put you on the spot. It's like naming the seven dwarfs. I'm not going to ask you to name them. I'm going to name them. I'm going to ask you to try to explain how they came to be, this little bundle of companies that are basically been moving the market and been talk of the town, both good and bad, for a while. So those names, in no particular order, are NVIDIA, Apple, Microsoft, Google, Meta, which is Facebook, Amazon, and Tesla. So there you have it. Those are the Mag 7. What do you think the Mag 7 did or has done to put them in this unique category apart from the other 453 names in the S&P 500, 493 names, excuse me.
And maybe you can, Mike, maybe you can remember who is the gentleman that coined the phrase the Magnificent Seven. It was quite a few years ago, right? But the reason why they were called the Magnificent Seven is these were not only the largest, but some of the fastest growing companies of the S&P 500, of the largest companies in this country. Not only were the fastest growing, but the most profitable companies. So somebody came along and coined them as the magnificent, the best of the best. And that has stuck through all the years, except not all of them have behaved the same way. Not all of them have and or continued to grow the same way. And we'll pick on one, Apple. Apple was, some people now are saying, very smart in that they stayed out of this spending frenzy to develop artificial intelligence. They pretty much said, yeah, you guys figure it out and then let us know. And so at first they were kind of like, oh, they missed out. They missed on the boat. They don't know what they're doing. They've lost their edge. And the price stock equally did not do as well. But now people are coming full circle going, oh, they were smart not to spend all that money. They were smart to wait to see how the dust settled and the stock prices perform positively. So even though they're bundled together, even though we talk to them as one group, they have behaved very differently over the last couple of years.
So here's what's fun. I'm glad you asked me that question. And ironically, I used AI to find the answer in a half a second. So the person who coined the phrase was a fellow named Michael Hartnett, no relation to me. And he is, hold on, he was an analyst with, I just lost the name, which is frustrating. He was at, hold on. Well, well, before I stumble and bumble over that, he got the nickname from the movie The Magnificent Seven. He was a buff of Westerns. And you remember when we were kids, The Magnificent Seven was a movie with Yul Brynner and
Oh,
Steve
classic,
McQueen.
classic Western,
So
absolutely.
that's
The
where the name
remake was
came
not so
from.
good, Mike, but that first one was a classic movie, classic Western.
And I'm pulling it back up now. It was Michael Hartnett, chief investment strategist at Bank of America, and he said it in May of 2023. And as I'm reading that, the AI reminded me, which I totally have forgotten about. Remember the expression "FANG stocks,"
Yes. Yep.
right? That
Facebook,
yeah,
Apple,
yeah.
Netflix, Google.
There's two A's, Apple and Amazon.
Oh, right. The Fang is spelled with two A's. Yep, you're
Yeah.
right. You're
So, I mean, come on, that seems so 2022, but Fang was like all the rage before the Magnificent Seven came along. So, as I said before, we're a business that loves our euphemisms and loves our acronyms. But I think it's just important to mention why we talk about this sector all the time and why it's become so important. But just to shift gears a little bit, what I also think is important, I was looking at some other numbers before the show, and a couple of things that struck me as it relates to the consumer. Between July 17th of last year and July 17th of this year, 6 month CDs then were paying 1.89%, and 6 month CDs now were paying 1.82%. A 30-year mortgage a year ago average was 6.77, and now it's 6.61. The one number that changed fairly dramatically, the prime rate went from 7.50 a year ago to 6.75. So my point is, there's a lot of talk about interest rates always as well when we talk about the economy. But overall, I don't know if you would agree or not, but the consumer has really been in this gap of a very stable interest rate environment, whether they were investing or whether they are borrowers.
I'm going to tie that into a conversation we always have, Mike, and that is headline risk.
Mm-hmm.
So if I had said to you, and we play this game all the time, hey, if this was the headline, if that was the headline, what would the market look like? And invariably, if you're looking at some of the headlines today, you'd think the market would be negative year to date. The data you just rattled off says we've had a relatively stable economy. And
Yep.
in fact, if we look at, and we get a little wonky all the time and look at the actual economic data, the economic data is relatively good. We can dice it, slice it, push it around, but at the end of the day, the economic data has been relatively stable and relatively good, and that includes inflation. I mean, we talk about it all the time. We get frightened by it. Head inflation's runaway. Inflation's this. It's kind of been relative, a little higher than it was in January, obviously because of the war in Iran and oil prices. Just most recently rolling over a little bit, starting to come down. We'll see what happens with the war. We'll see what happens with oil prices. But overall, inflation has been relatively modest through the last 12 months or so, plus or minus 2.5, 2.75%. Not where we wanted to be, but pretty good overall. GDP growth, unemployment numbers. I can go on and on, Mike. The data is relatively good. And people go, well, the market's overpriced, the market's not behaving correctly. If you look at the data, it's really not, Mike. It's really behaving itself relatively well, considering the amount of headline risk we have out there.
Yeah, and I could not agree with you more. And really, the point is the inflation number, you mentioned it, Dom, is 100% explainable in a way that actually applies some logic without fear mongering. And the difference between the inflation we had now and the inflation we had in 2022 is that inflation was going up then because everything was overheating and the economy was getting a little too hot and the Federal Reserve was way too slow to react. And as you pointed out, inflation now is clearly tied to the war in Iraq, our inability to end the war, and there's the high price of oil, which again I'm not minimizing at any stretch of the imagination. It has a real effect on people's pocketbooks, but there's no reason to strike fear in the heart of the consumer because the inflation is explainable in a way that does not at the moment is not causing a systemic breakdown in the economy. Do you agree?
Absolutely, Mike. Absolutely. Look, again, I feel like sometimes we're repeating ourselves, but our heart breaks for people that are living on fixed income. Imagine somebody in this country who their entire income is a Social Security check, and now they have to go out to whether it's to buy to the drugstore to get their prescriptions, or they have to go to the supermarket and buy food, or God forbid, go and gas up their car. That extra $50, $100, maybe more, that really hurts, Mike. That really hurts. But on the other hand, there are people that are duly employed, that have resources, and the market goes up, and the price of homes keeps going higher, wages keep going higher, and so even though it's kind of annoying, being polite, to go and gas up your car, at the end of the day, it doesn't move the needle in the context of the economy's ability to sustain it and continue to grow. And up until now, that's what's gone on.
Right. And I also think it also comes back to people having job security. Because if they're not in fear of their job, if not in fear of getting laid off, as you said, they'll bite their tongue. And most people, I would say 2/3 of the economy of the population could afford. It's annoying, but they could afford these higher gas prices. And I agree with you. So 1/3, the lower half of the population, that the high price of gas really takes a large percentage bite out of their living expenses, which is unfortunate.
Yeah, and Mike, another great point on your side. If people are fearful that they're going to lose their job, or they're looking around and seeing other people lose their jobs in quantity, right? We're not looking at the layoff here or there. Then they're going to stop spending. That's classic. I'm not going to spend money because I don't know if I'm going to have a job tomorrow. But that fear really doesn't exist for the most part. Now, we are seeing like younger people coming out of college having a harder time finding a job. People that are actually getting laid off are also finding it a little bit harder, a little longer to find a job. But we're not seeing the mass layoffs that some of the experts had predicted, 6 months ago, a year ago.
So doesn't that tie back into the phenomenal earnings growth that we're seeing this year? I think you said earlier, 15 to 20% year over year growth. Isn't that, just for context, isn't that a phenomenal number?
It's a phenomenal number in the context that most experts really were not called. They would talk. I mean, Mike, we talk to the analysts all the time. You as me, our team. They were predicting positive earnings growth this year and for the quarter. But then don't forget, we had the whole thing with tariffs. They were in and they were out. Then we had higher oil prices. Then they came down. Then they went up again. Now they're coming down. Now they're going up. So there were a lot of moving parts here. But a 15% earnings growth, 14.8 profit margins, just extraordinary. And again, the negative in that number, the only negative is it's kind of concentrated in these large tech companies. But the rest of the companies are making money. We just had earnings reported by the largest financial institutions in this country, the biggest of the banks, and the biggest of the money centers. The numbers were extraordinary, Mike. They just knocked Wall Street out of the park. They couldn't believe it. So again, it's a glass half full story, but it's hard to argue that anybody. Mike, have you heard anybody use the word recession in a long time?
No, no, not. Oh my God, we talked about it ad nauseum in 2022. Remember the soft landing, the hard landing, the no landing. We haven't talked about that literally, Dominic, in 2, 3 years.
Yeah, and it's this economy again. When I'm not going to sit here and tout, oh, it's spectacular growth, but given the circumstances, it's pretty good. It's pretty good.
Yeah, and just getting back to what you said about earnings. So in the second quarter, in the first quarter of this year, the semiconductor sector contributed 31% of the earnings, and the overall and the hyperscalers were 34, and the rest of the S&P was 36. So it's kind of third, a third, a third. The semiconductors have taken control of the S&P 500 from an earnings point of view. They accounted last quarter for half of the earnings of the S&P 500. And what you said earlier, taking that share primarily from the hyperscalers who didn't contribute as much, that Mag 7, they're taking a breather, but still 43% of the growth, and if it's 20% a year, I'm sorry, quarter over quarter, is from the rest of the market. That's not terrible either. So it is a little bit encouraging to see that the market is spreading out a little bit and we're getting a little bit more growth from other sectors, not just IT.
So we kind of mentioned that these tech. Well, let's talk about the chip stocks specifically. They've had a huge run up this year, and then they've given a chunk of it back. But here's kind of a loaded question, Mike. If you just own the Magnificent Seven, again, the Apples, the Amazons, the Googles, the Metas, how much money would you have made this year?
I don't think you would have made any.
Pretty good guess, Mike. And I want to go maybe just the last week. The Magnificent Seven as a group is up 1.47%. Basically a little bit over 1%. So their earnings have been pretty good. As you mentioned, they're a large component of the profits of the S&P 500, but investors have run away from these companies to buy other companies. The other companies, the microchip companies that you just brought up, but also these other companies in the S&P now. The world of investing is expanding, so it's not just these Magnificent Seven. The microchip companies are a little frightening because they've gone up so much. But on the other hand, that people are looking at healthcare companies, they're looking at banks, they're looking at manufacturing companies. That's a healthy answer to what the market's doing.
Yeah, and I mean, to your point, these companies have to put all this equipment somewhere, right? So, if you want to get involved in some of the growth that's happening with IT, but not by IT, look, there's shovels in the ground. These data centers have to be built. These enormous distribution centers have to be built. Amazon, they're building distribution centers all over the country. I don't know if you noticed, Dom, on your way to work, heading westbound, Trader Joe's is building a giant distribution center where Computer Associates used to be, right? So there is now, that's not an AI company, although I venture to guess that that building's probably going to be run by robots, not people. But the amount of building a new construction that's going on to house all this equipment is unthinkable at the moment.
Yeah, and again, we keep politics out of this conversation as much as we possibly can, but there has been a real drive to bring manufacturing into this country. We know under the prior administration, the CHIPS Act to incentivize computer companies to build these computer chips in this country. This administration has been a real focus on bringing manufacturing back, and whether it's data centers, whether it's these chip manufacturing centers, distribution centers, there's been a real renaissance in construction in this country and in manufacturing in this country, and we're at the beginning stages of it, Mike. We barely touched the tip of the needle on this one.
And just one more point, and then we're going to have to take a break. You mentioned the banks, and I think it's more of the investment banks have done really well than the retail banks, and I think some of that is due to some of the big IPOs that came out in the first half of the year, which certainly helped contribute to some of their earnings, didn't it?
You're absolutely spot on, Mike. So if you look at the big names, the Goldman Sachs, the JP Morgans of the world, Morgan Stanley, these new companies, specifically a SpaceX, but many more than that, they've added to the deal making that these banks have produced and profits they've produced. But I'll give you a flip side of that, Mike. A lot of these banks and the regional banks as well, maybe even more so, they put money aside, they put reserves aside for potential losses. So, given what the economic cycle looked like not too long ago, hey, we might have credit card delinquencies go up, we might have car loan delinquencies, mortgage delinquencies, and they have to put reserves aside for that just in case. Well, here's the good news, they haven't had to use it. They've had those reserves aside. We've seen car loans and the credit card loans slightly higher in delinquencies, but not the really negative case that some people were talking about. So in that context, corporate profits, bank profits have done better because they haven't had as many losses as maybe they anticipated.
And again, that was a full circle back to people are feeling good about their jobs. They have job security, and especially car loans, Dominic. I mean, that's the last that you're going to pay your car if you need to get to work, right? You're going to pay for that car loan. So car loans, I've been told, is normally a pretty good bet by the banks. But you're right. The delinquencies and overall the economy is just on pretty solid ground.
And Mike, I know we got to take a break here, but real quick. So we've heard from the major, the Bank Americas, the JP Morgans, and one of the things I pay attention to is the consumer debt, what you're bringing up, right? And they have not seen a big tick up in delinquencies, and spending continues to be through the roof. So no matter what people say, they still going out there and spending money.
Thank you for that tee up for our second half, because what we're going to talk about when we come back is the World Cup just ended. I know more about soccer than I've ever known in my entire life, and I just want to talk a little bit about how the rest of the world viewed us from an economic point of view, as they enjoyed traveling the country and watching. I guess we call them football games now, not soccer games. But Dom and I will be right back after a quick break.
You are listening to the Lebenthal Report. If you have any questions or comments, please send an email to contact@lebenthal.com. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner Dominick Tavella on the Lebenthal Report. So, Dom, as I mentioned before the break, the World Cup just ended. In full disclosure, up until 2 weeks ago, I never watched more than 5 minutes of soccer in my entire life. That being said, I did watch the American game, and in 80 minutes, they had two shots on goal, and now I knew why I never watched soccer in my life. And I know I sound like an ignorant American. I get it. So we call it football. A field is called a pitch. It's not 1-0. It's 1-0. Those are my takeaways. And the goal is the size of a 4-car garage. And I don't understand why there's two shots on goal. I'll never understand that. But that being said, what I read a story this morning from the Carlisle Group, and basically what they talked about was all the visitors that came to this country, and their takeaway from visiting here and traveling the country and being in our 10 or 15 largest cities, New York, Boston, Seattle, Dallas, I don't know where they were, but the takeaway was that rather than feeling that there's very few people who hold all the money, that when foreigners were in our country, what they encountered was a broad abundance, massive and elaborately stocked supermarkets, sprawling suburbs, and of course, packed state-of-the-art stadiums. While such impressions hardly invalidate the notion of a K-shaped economy, they helpfully contextualize a dynamic typically subject to caricature. And really, I was struck by that because, yes, and we talk about it all the time, we talked about it in the first half of the show, we certainly have a K-shaped economy where there's the haves and the have-nots. But I don't think it's 50-50. I think it's more like 70-30 or 60-40. And if you are visiting this country from someplace else, the suburbs are thriving. The supermarkets are always full. We have brand new stadiums all the time, and these stadiums are packed. And to me, that kind of is more proof, Dom, that the economy is truly on our economy, is truly on solid footing.
I didn't read that particular article, Mike, so I'm going to reserve a little bit of commentary on that particular article. But I do know that for the most part, the visitors, foreigners that came in to watch these games, which was a considerable number of them, were genuinely surprised, genuinely pleased, genuinely impressed with the overall culture, nature, economy, everything you brought up. Like as simple as going into a supermarket and seeing everything on the planet available to you, being able to get a pizza at 3 o'clock in the morning. I mean, just things that we take for granted. So from that context, it was a good showing by America. You always worry about this stuff. We have enough problems with our reputation around the world. We didn't really want to have to challenge that even more than it's already challenged. I think they did an amazing job. Credit to the organizers, credit to the companies, the stadiums, and credit to the American people for really being good, gracious hosts. I heard very, very few problems, Mike. I don't know if you would disagree with that point. But if you allow me just a little bit of latitude, I travel a lot around the world. I know you do as well, Mike, but I travel a lot. I spend a lot of time not only in Europe, but South America, Africa. And there's a great deal that we just accept and take for granted in this country. We just think it's normal because for us it is. But I promise you that is not true everywhere in the world. and throwing in everything else that we take for granted. Sometimes we just need to take a deep breath, watch the headlines a little bit, don't take them too serious, and be grateful that we have the life that we have.
100%. But I will point out the only complaint that I heard, it was kind of my favorite story of the entire World Cup, is apparently Scotland was playing in Boston. And apparently the Scots drank all the beer in Boston. And Boston, of all places, ran out of beer.
I'm going to probably say it was happened at the stadium. I don't know. Maybe the local pubs, but apparently they did put a serious dent. If you could imagine beer in Boston, is any of the two things that go together more than beer in Boston? I mean, for God's sakes. Yeah, I did hear that they did have a problem with the quantity, both available and drank, that it was drank that day, that weekend, whatever. They did. And my favorite story was that the winning team, Mike, the championship team, all they wanted was pizza. So all the great things we have to eat in this country, their favorite food was American pizza. So yeah, there we go, Mike. Pizza and beer. It doesn't get any more American and better than that.
It does not get any more better than that. I know you're going to Italy soon, but yeah, we make some pretty good pizza. I will argue that. So, but on a more serious side, the term that you and I hear all the time is mass affluent, right? The mass affluent, and really, Dom, that's the consumer. And it really got me to think, who is a mass affluent? Like, what is the definition of that? Who falls into that category? And really, it doesn't take much to be considered mass affluent in this country. It's an income of basically between 75 and $100,000, and liquid net worth, excluding your home, of 100,000 to $1 million. So, and those are the folks, Dom, that are buying these tickets, that are living in the suburbs, that are filling up these stadiums, not only for soccer matches, but
We went through with the Knicks game, Mike. You and I, again, we lived it through that whole period of time. But the prices that they were getting to go to the finals, fans to pay for tickets to go to the final was outrageous. But yet, every ticket was sold, right, Mike?
Every ticket was sold.
Every ticket was sold.
And during the football season, I know it's only 18 weeks, 17 weeks, whatever it is, 17 games. Dom, every stadium sold out every week.
And look, you can argue, Mike, that there were a lot of fans that came in from abroad, right? Whether the French fans came over, the English fans came over, it doesn't matter. So I'll say a lot of those seats were taken up by foreigners that came in to watch their team hopefully win. But a lot of the seats were taken up by Americans who wanted to experience the whole joyful event and the celebration. And it was spectacular. They did it again. Compliments to everybody involved. They did an amazing job. But back to your mass affluent.
Yeah.
It's kind of a running joke I have with clients that come in, and I kind of whisper in somewhat tongue in cheek, do you consider yourself a millionaire?
Mm-hmm.
And how many times do you get that? You give out that question, Mike? And what's the average answer you get?
No.
No. Well, I'm not a millionaire. What are you, nuts? I'm not a millionaire, right? We get that all the time. No, what are you? I'm like, but your house is worth this much. Your 401k is worth this much. Your bank savings is worth this much. Your portfolio. And on paper, you're worth X dollars. And they're like, it's just a number. I'm not a millionaire. And that's, to us, is our typical millionaire, appropriately defined as the millionaire next door, where these are just hardworking people that have accumulated a few dollars over their life, and all of a sudden they wake up and they go, I don't know where I got all this money from, but I'm grateful I have it and I can enjoy a comfortable retirement.
So to your point, going back to this article, and I know you love saying trillion, but I'm going to say it. Since 2019, the value of 401k accounts in this country, and there are approximately 73 million households with 401ks. Dom, if I said to you the value of 401k balances has increased 12.7% a year, which would equal since 2019 $6.7 trillion. Would you be kind of nonplussed by that? Would you be surprised by that? I mean, to me, it kind of sounds spot on since we live this every single day.
We live it every day, Mike. We are blessed that we work with a lot of individuals that are just getting ready or just retired, and now they have to figure out what to do with these assets. Whether it's a 401k, a 403b, 450, it doesn't matter. And they walk in and they got $500,000, they got $1 million, they got $2 million. And again, we're talking about hardworking people. We're not talking about somebody who won a lotto ticket. They're just people who squirreled money away when they were younger, and they wake up 20, 30 years later and they have a really decent amount of capital to help them fund their retirement. And given all the negative news surrounding Social Security and its availability, and who's going to get it and how much they're going to get, boy, it's a blessing for those people that squirreled money away years and decades ago and let it grow. So between the money they were putting away themselves, company matches, company profit sharing, earnings in the market. I know there's good years and bad years, and the world's going to come to an end, and the world's going to be spectacular. But you put it all together, Mike, and time, compounding of those earnings over time, and people retire in a comfortable position.
It's funny because I use the word to describe my clients to them frequently. I use the word affluent because, and justifiably so, no one likes to pay taxes. So when a client tries to ask me, well, how do I get out of paying taxes on my IRA withdrawals? Or how do I get out of paying taxes on my capital gains? And I try to explain to them that there's no escaping these things, and the government considers you affluent. And sometimes I say it just kind of to get their response. It's almost like they stiffen, like the idea that their own perception of them being affluent is just so foreign. But to the rest of the world, the blessings that we have and these 401k balances and the homes, we do, a large part of the population really does fall into that category.
And look, Mike, again, humor is always a good thing. I try to explain to my clients that paying taxes is a good thing. And I know I get the look and I'm like, are you stupid? What are you doing? What are you saying? But if you're paying taxes, it means you have balances in your retirement account. If no balances, no taxes, right? So paying taxes is a good thing. If you have capital gains, it means your portfolio had a profit. But having a profit's a good thing. So sorry you have to pay the taxes on it. That's just the way our government works. But that means you had a profit, and having a profit is a good thing. You have a small business and you had to pay taxes. It means your business did well. These are good problems. So nobody likes to pay taxes. You and I don't like to pay taxes, Mike. But at the end of the day, paying taxes means you have a positive event to work off of. So I want to say it's a good thing.
I agree with you. And my again, you're the son of a bricklayer. I'm the son of a truck driver. My father used to tell me all the time, don't complain about paying taxes.
Yeah, it's means something positive happened, right? So look, we are in an area of the world, the economy, the markets, where basically we are dealing with people that have accumulated some amounts of assets. But I always like to say there's a group of people out there that are struggling. There are a group of people out there that have it hard month to month. And so, listen, our heart breaks for those people as well. And back to the discussion around inflation, I don't know that we're going to see prices going lower, but I do hope that prices stabilize and don't go much higher.
I agree with you. So that's another great segue for me. Thank you. With the last few minutes of our show, we're halfway through the year, a little bit more than halfway through the year. So time for crystal ball, Dom's crystal ball. Let's start with interest rates. Are they, between now and the end of the year, are they going higher, lower, or staying the same?
I've been pretty adamant about this. The market seems like it changes its mind every other day, Mike, but I still think interest rates are lower by year end than they are now. Now they've spiked up a little bit. Again, that ties into higher energy prices. Higher energy prices means higher inflation. So in the short run, we've seen interest rates pop up a little bit, but I think if we can solve, I hate to say it this way, that we can solve the Iran war problem, then things will roll over and we should see lower inflation and lower interest rates by year end.
So you and I hardly disagree. I'm going to take the opposite position because of what you just said. I think this war in Iran is becoming quite the quagmire. I really felt very strongly we had to be out of there. This had to be resolved by July 1st. We're not. It's going on and on and on. It's kind of reheated. And as a result of that, I don't think when they're going to raise interest rates, I don't think there's going to be a reason to, because if we get another increase in gas, I think that's an artificial interest rate hike. But I would be surprised, Dominic, if we got an interest rate hike. I'm sorry, an interest rate cut between now and the end of the year, because I'm not that optimistic that this, no longer am I optimistic that this war in Iran is going to be resolved anytime soon. It just seems to be going on and on and on.
Yeah, Mike, I'm going to stick with my guess, but I do have to give you credit that if you say what's the one thing that keeps you up at night, if what's the one thing that derails this economy, and that is an all in all out blitzkrieg in the Middle East, right? There's some talk now that the Houthis, which are allies of the Iranians, might turn off the other side of distribution for oil in the Middle East. If this thing really goes downhill and oil pops to $150 a barrel for an extended period of time, yeah, all bets are off, Mike. We're looking at interest rate hikes. We're looking at inflation going through the roof. We're looking at an economy that comes to a screeching halt. All bets are off. All bets are off. So I
Yeah,
will give
look,
you that.
and I do think I wasn't even thinking $150, but I think $100 for an extended period of time could create a drag on the economy, which again, if it's a drag for a long period of time, maybe they'll cut interest rates then. But I don't think any of this could unfold quick enough for the Feds to react by the end of the year, other than the new person who has the job. I don't think he's going to react to an audience of one, but we do know that the man in the White House certainly wants lower interest rates. So to your point, I don't know if we can necessarily discount that entirely.
Yeah, we have a new Fed chair, and we don't yet know how he acts, thinks, reacts. But the preliminary word we're getting is that they're willing to look through the short-term inflation, thinking again, if oil prices roll over and go down, then that inflation will start to go away. It'll take some time, but it'll start to go away. On the other hand, if this becomes prolonged and inflation really were to spike up, they're not going to have a choice, Mike. They're going to have to raise interest rates. And again, all bets are off now. We're painting kind of a rosy picture about the economy, and I think it's a valid picture. But like storm clouds, they can easily change and become very violent. And our best guess is that's not going to happen. But to say that it definitely is not going to happen, I think it is wrong, Mike. I think you have ground to stand on when you're making your prediction.
Thank you. All right. The S&P 500 as of Friday, July 17th, was around 7,500, 7,458 to be exact. Do you dare to venture a guess what the S&P 500 is in 5.5 months?
I'll say venture a guess, but in the context that, we listen, right? And that doesn't mean they're right, but we listen to every major financial institution on Wall Street, and most of them are somewhere between 7,800 to 8,000 on the S&P by year end. And again, they're looking at the data we're looking at, Mike. They're looking at the growth, the earnings, the inventory, all the leading economic indicators that we're looking at, and that paints a decently positive picture. but I'm going to still qualify by going, these are very smart people. They have really large research departments, economics, background, firm, everything under the sun to look at and focus on. And all bets will be off if oil goes to $150 a barrel. It's as simple as that. So positive expectations through the end of the year, Mike, with a big asterisk. Tell me the outcome of the Iran war, and I will tell you what this picture is going to look like on December. I don't need a crystal ball that works, Mike. Tell me what happens with the Iran war, and I'll tell you what this picture is going to look like on December 31st.
I agree.
And I say you can do it as well, Mike. This is not brain surgery. We can pick. We don't need one of the major Wall Street firms to tell us. We can figure this one out on our own.
Correct. And the other thing I think, which it's fairly obvious, is if this war continues to drag on, into the fall, then I think the Republicans will lose their stronghold running all branches of government. And again, you and I have invested money through many, many, many political cycles. That's not necessarily, again, not a political statement, but a split government is not necessarily a bad thing in terms of the economy, because it sounds counterintuitive to say, but the markets and the economy doesn't like surprises. And you could almost think not much will get done in the last 2 years of the Trump administration if there is a split political structure.
Yeah, so the glass half full, it just means if there's a split Congress that they would have to compromise. Here's a concept. They would have to compromise to get anything done. It can't be one party or the other 100% what they want. And generally speaking, that ends up being a more positive end result. The flip side of that, Mike, is anytime I think historically, anytime we've had a mid-year election, the markets get pretty volatile prior to the midterm. So we can expect some pretty significant volatility, I think, prior to the midterms. I would not be surprised.
Before we go, then we can't leave this. You talk about volatility. What's your definition of volatility? A 10% move, a 20%
Yeah, I would say
move?
at least, I would say, 5% moves, I think are kind of normal. But a
5% move is a Wednesday. I mean,
yeah.
we get those all the time.
Well, it's okay. So I don't want to digress because we're running out of time. But there's some analysts out there we have a lot of respect for. We listen to what they have to say, and they talk about 10 to 20% pullback. Would not be shocking. But here's the one add-on. We've already had that in the semiconductor space, and yet nobody's blinked, Mike. We've had 20, 30% pullback in semiconductors, and no one's even noticed. So I don't think it'll be quite that subtle. It might be a little bit more broad-based. But historically, the uncertainty before midterms puts a little volatility in the market. So a 10% pullback, I think, would be quite normal.
I mean, that's the point.
I wouldn't worry about it either.
Me neither. It would be quite normal. And by the way, not only did the semis do that, but didn't the whole market do that in March when we started this war?
The market again, our portfolios did not, but the markets were down 10 plus percent from the highs. Again, recovered it all, and now we're ahead of the game by a very nice number. But yeah, we had a pretty significant pullback in March when the whole Iran war thing started.
Yeah, and then again, in the S&P right now is still up 10%, and then
and Mike, we say it all the time, but it's good for us to repeat it out loud. Think about the person that bailed out. Think about the person that got out of the market, doom and gloom. They were looking at the headlines. Oh my God, we're going to lose all our money. Not only would they have gotten out when the market was down 10%, they would have missed the 10% up, and that's a 20% swing from the bottom to the top. Plus 20% plus. So stick with it. Stick with the secret sauce. You'll be fine.
Yeah. I mean, you're right. I mean, just to close on the point, in the last 3 years, which is 2023 to now, the S&P cumulatively is up 71%. The Dow is up 59%, and the NASDAQ is up almost 83%. So yes, that stick-to-itiveness and having a plan certainly,
and we've had multiple 10% drawbacks and some 20% plus draw it down. That was the tariff fiasco at March of last year, and yet the markets recovered and way ahead of the game last year, and so far way ahead of the game this year. So sticking with the secret sauce is the way to go.
And just the last footnote, I want to say it again. The numbers that I quoted tonight were from JP Morgan's weekly market recap. We're not making this stuff up as we go along. So on that note, Dom, I will see you next time on the Lebenthal Report.
Have a great evening, Mike, and we'll see you all next week.
Have a good night, everybody.
Thanks for tuning in to the Lebenthal Report. Dominic and Michael will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week. The Lebenthal Report is brought to you by Lebenthal Global Advisors, LLC, a registered investment advisor, and Lebenthal Financial Services, Incorporated, a FINRA-registered broker-dealer. This podcast is for informational purposes only and should not be considered investment advice. The views expressed are subject to change based on market conditions. For more information about our qualifications and business practices, visit our website, lebenthal.com, where you'll find links to SEC's and FINRA's official resources.